you've worked hard for your money and you had to sacrifice to save for a comfortable and secure retirement. And I want you to get all of the joy from that hard work and sacrifice. And in today's video, I'm going to share with you some things as a financial advisor for over 20 years that I shared with people that often resulted in them spending quite a bit more in retirement, oftentimes 25, 30, maybe even as much as 40% more than they otherwise would. And this makes a big difference. Imagine being able to spend a third more than what you're currently planning on. So let's jump in and let's start with a rule of thumb that a lot of people use that I think has some major flaws. And that's the 4% rule. And the 4% rule basically says you can take 4% of your money out of your account every year if it's invested about a 70-30 allocation, and not have to worry about running out of money over a 30-year time period. But, and that is, when you look at it holistically at everybody, that's not a bad place to start. But for many of us, we're not going to be in the worst case scenario. In fact, the vast majority of us are not going to be in the worst case scenario. Most of us are going to be at the median or above, or I should say half of us will be at the median above, which says that we can spend quite a bit more. But how do we navigate this period? Because we don't know until it's time to look back in hindsight. Are we going to be fortunate and get good stock market returns, or are we going to get bad stock market returns? Okay, there's a new approach that a lot of financial advisors are using. It's called the guardrail approach. And basically it says, let's not plan on the worst case scenario. Let's plan on maybe the median case scenario and adjust as we go along. And I thought this article I'm about to share with you by Morningstar did a really nice job of explaining this. So the article's called How to Spend More in Retirement. It's an excerpt from the book How to Retire by Christine Benz. And in that book, she talks with retirement spending and financial planning retirement researcher Jonathan Guyton. And Guyton and his partner are generally credited with this concept of guardrails. And the good news is with guardrails, most of us can spend, instead of 4%, you can see that in Morningstar here, they're going to be talking about spending a little over 5% a year, 5.3. But let's jump in by this article on Morningstar by Christine Benz. And she starts off saying the 4% guideline for retirement spending is a decent starting point when determining whether you have enough to retire. I agree. You don't want to make the decision to retire based on that, but it's a decent starting point. But as I mentioned, it was developed for a worst case scenario in markets, and much of the time, the markets perform much better than that. And so with her conversation with Guyton, they talk about a flexibility-based system, or the guardrail systems. And in that situation, in a normal environment, if you're willing to be flexible and know that your spending may change some from year to year, then you can have a higher withdrawal rate. And in this case, Guyton says he's just going to use the number that came out in Morningstar's 2022 retirement income research. 5.3% was the number that came out of that. He's going to use that as the starting point. And then Guyton goes on to say, what you then do is you establish a top end and a bottom to that, and simply 20% more or 20% less. These guide rails are nothing more than a range that you want to stay in between. In this case, 20% above 5.3% is 6.4%, and 20% below 5.3 is 4.2%. Now you can see that 4.2% is awfully close to the 4% rule, right? So Guyton is saying here, in this case where we're starting off with a 5.3% starting point, the withdrawal rates can be between 4.2% and 6.4%, but we're going to start at 5.3%. Okay, let's keep going. So Guyton goes on to say, there's your range. And so you go merrily along in retirement. When your portfolio goes up in a given year, you give yourself a raise equal to inflation. So in this case, we started at 5.3%, and then we give ourselves a raise equal to inflation. So we're gonna, let's say we had $1 million. The first year we took out $53,000, and just for easy math for me, If inflation were 10%, you would take out an additional $5,300 for a total of $58,500. And so that would be your range. And then you'd look at your portfolio and say, does it fall within this range of 6.4% to 4.2%? And if it does, you're fine. Well, let's keep going with the article. I'll get to what if your portfolio went down that year. What the guardrail system does is says we expect to be average, and if it turns out to be even better than that, that we're better than the median, then we have a way to bump up our spending. If it turns out to be worse than that, there's also a way, unfortunately, to bump you down. He goes on to say, there's no free lunch. If it turns out that the investment hand you've been dealt in retirement is so bad economically, so sequencing return risk, you got bad returns in the early years, so bad economically that it ends up being one of the realistic worst case scenarios, fear not, the guardrail system that decreasing will take you back down where you should have been along very quickly. You won't like it, but it will get you there with the same chance and the same sustainability. So essentially, any year where your portfolio value goes down because the stock market was down, you get no raise. In the year, you don't take the inflation adjustment. In the years where the stock market was positive, you look at your raise, and as long as that raise keeps you below a 6.4% spending range, then Guyton would say, you're fine, take that. If it gets above that, then you come back down. You take if it's above 6.4%, you have to make a shift. We would knock that withdrawal rate back down by 10%. And if it's below 4.2%, you get to make a different shift. You get a raise of 10%. And if it was a year when you were in that range, but your portfolio lost money, you're gonna skip that. So that's how the guardrail system works, high level. I do want to thank Christine Benz, who's the author of this article, but also the author of the book, How to Retire. And this article were excerpts from that. This video is not sponsored. It's not an affiliate link, but as a thank you to Christine, I thought that article was excellent. I want to share her link here. I think that book shares some really good insights on something that can be complicated, which is this idea of guardrail systems. And the challenge with the 4% rule, the good thing is it protects you from the worst case situation. But the bad thing is it limits your spending to the worst case situation. And you've worked too hard for your money to say, I'm going to be one of the, if you run a 10,000 simulations Monte Carlo, do you really want to say you're going to be one of the 500 worst situations out of 10,000, or do you want to say there's a good chance I'm going to be the median situation, or maybe even better? And if so, I want to have had access to that money if I wanted to spend that money. So how much we spend in retirement, how much we save for retirement are critically important decisions, and when we retire is also critically important, which is why I made this video up here, why waiting to 65 to retire might be a big mistake. Thanks for watching this video. I'll see you in the next one. Bye-bye.